So I talked about how the dollar index would obviously use the inversion fair value gap here. And we had some bullish buy side imbalance, sell side inefficiency. And then we had another inversion fair value gap here with a suspension block. You can see the imbalances here. It's not noted like this one is here. I'm not going to draw it out, but you can see it there and there. And then we traded down to consequent correction of that suspension block perfectly, ran from that. And then we had this suspension block here, which is a bullish fair value gap with a volume imbalance at the high and the low of it. Okay. And then look at the bodies respecting the upper half. Yes, we can travel down to the low of it, which it does there. And then we hit the lower quadrant on that candle. Now, what does he mean by that? If you're looking for something that's going to be bullish, okay, if you're looking at something that's going to cause and be a catalyst for price to go higher using my concepts, what would that look like? The point is this: knowing what makes the market go up, there has to be some underlying premise. What was the premise on the dollar index? This low swept it there. And then we want to look for a low risk entry to a market maker buy model. Oh. So what you're saying is anytime that the market enters into a buy program, that means it's going to remain bullish for a length of time until it trades and traverses to an opposing pool of liquidity. That's the technical term that you'll see in the book. Okay. What this is it's smart money reversal. Smart money reversal will always, this is for your notes now, okay, will always be a purge on liquidity, whether it be a market maker sell model, which would be the opposite of this high down to that low, coming all the way back up, traversing right back to that liquidity there. They don't have to look perfect textbook, but the mechanisms behind where price is going and why it's going to go there is still remaining constant, meaning that yes, there was a willingness for traders to go long here. Wonderful. Supply and demand, not a factor. Support and resistance, not a factor. Liquidity, absolutely the lifeblood of the marketplace. So you got to stop thinking about, where prices caused the last buying thrust or the spring lower. Okay. Forget all that Wyckoff stuff. Graduate from it. Look at the market a little bit deeper because there's a whole lot more going on that are very, very precise, very specific things that repeat on a time-based delivery. When market went down below that low here, what was below that low? What would be resting below that low right here? In terms of liquidity, it would be sell stops, pending orders for two things. First, those individuals that went long or anywhere in here, they're not going to feel safe by putting a stop loss that's real short. They're going to want to go back to this low here because they're going to see that that is what? Well, that was very strong support because look how the market reacted. Yes, I'll give you that. It reacted like that. Wonderful. But I'm not looking at that as I'm gonna wait till it goes down here and touches this and go long. No, I want to see it go below it. Because what that will do, it will give me immediate feedback on whether or not this was a raid or if it's going to continue going lower. So the market probes below that here. So it moves below that low there. So it opened. Look how this candle formed. And these are daily candlesticks. So when the market's reaching below an old low like that, I want to see it travel below it. And by opening above that low being here, this candlestick opened right there. And then at that moment, it starts dropping down to that low. Now, support and resistance folks would be like, okay, it's going to go up right there and want to go long there. And they may elect to go long like that, but I'm not doing that. That's why I don't trade support and resistance. What I'm looking for is, does it trade down below it? Why is that important to me? Because number one, everything that causes the market to rally high and low is always on the basis of a market maker sell or market maker buy model. Every fluctuation in price action could be broken down fractally to that very premise right there. Regardless of what you trade as a model, your entry, your silver bullet, your model 2022, for instance, model 2022, that is low risk entry. That's the part of the market maker sell model or buy model that you're trading. You may not have ever identified it as such, but that's exactly what that is. Turtle soup, that's the smart money reversal. Maybe you've never known that. Maybe you never identified it as such, but that's what it is. Second stage reaccumulation or second stage redistribution, which is the unicorn of the models, that is the biggest, most explosive, sustained price run that trades to the opposing liquidity of a market maker sell or market maker buy model. Now, for someone that's new, that sounds like a whole lot of mumbo jumbo, but I'll explain it in a moment, okay? But those continuations are simply silver bullet premises applied to that time frame that you're seeing the market maker model on. By having an understanding that the market's going to traverse from buy side to sell side to buy side, and it's going to move from buy program to sell program, okay? By expecting the market to provide you stepping stones, little footholds, if you will, moving from one position to the next. So by having the expectation and anticipating that price will drop down, let's break it down into even a smaller scale. And what I'm saying here is not just applicable to the dollar index, but I'm telling you what you can do with this information. You can scale this to any measure that you want. But for someone that wants to take a stab at this and learn how to do it from a less of an intraday perspective, you can do something like this. We know at this day when it opened up on this price, and we know we're real close to that low. So you can do something what I taught is called purge and revert. You don't have a way to get in and trade intraday. Okay. This candlestick opens right there on that day. So right away, you know that there's a strong potential that the market's going to traverse from that opening price to that low. Okay. Why? Because there's liquidity and it's so close. It's called close proximity. This opening price to that candlestick's low, close proximity. So if you are a day trader, a scalper, what do you think might be beneficial for you in this condition right here? You know it's going to act like a magnet and draw you down to that liquidity because there's orders below that low. What kind of orders? Sell side liquidity. So that sell side liquidity is doing two things. Number one, it's protecting the long holders with their stop loss below that low. Who would do that? There's lots of traders that do that. But maybe there are individuals see that low and they think the dollar index is going to go lower. And they think once it goes below that low, they want to sell short on a breakout. So there's sell stops protecting long holders or sell stop entry as a mode of entering going short. And you see it doesn't spend too much time down there. So as a day trader, in your Forex trader, when you see the daily chart, which is again what I teach many times, you want to look for these pools of liquidity, these draws on liquidity on the daily chart in the direction that the monthly and weekly instigate. Where is it really moving? Where's the strongest tide pulling us on that monthly and weekly chart? And there isn't a whole lot of changing of that tide. It stays in place for a while. But it's hard for you to stay on that side intraday because you're seeing 50 handle runs out of nowhere. Where'd that come from? Oh, I'm probably on the wrong side. Let me change my long-term bias to this now. What does it matter on a 1-minute chart, 15-second chart, 5-minute chart, 15-minute chart? What does it matter if it rallies up real strong like that when your higher time frame bias is bullish or bearish? That's infancy. That's immaturity as a trader because you're allowing short-term fluctuations and volatility to screw up your perspective and you get misaligned and you abandon this idea that's based on higher time frame premise and you get yourself in all kinds of potluck trouble. As a Forex trader, the day that it opened up right here on the dollar index, you know that what's the dollar going to do? Strong likelihood that it's going to traverse intraday during this daily candle. It's going to trade down to that low. And the way I teach, it's going to reach below that low because there's liquidity below it. Now, as a scalper, as an intraday trader, for Forex, if dollar's going down, if it's going down to that low, that means you have short-term scalps that you can go long on euro and pound dollar. Anything with the dollar index second in the name of the pair. That's a buy scalp because dollar's going to drop to that low. So right there, all of a sudden, this same premise, even though we're looking at it on a daily chart, if you see this low here, say it was a hourly chart that we're looking at, not a daily chart. Okay. Same premise here. The hourly chart, the hourly candlestick would be opening here. You know that it's likely to do what? Strong likelihood that it's going to want to drop down to that low. It matters not what time frame you're trading on. It's the same idea, same thing being applied. But you can see how these ideas can be beneficial to you. And that's why I teach that if you use an hourly candlestick, like a daily chart, you'll never run out of setups. Every single hour, there's something to do. Now, for the working class hero, this is for you, okay? You can't trade intraday charts. You can't trade smaller time frames because you just simply can't do it. That is not a problem. Okay, it's not. All you have to do is change your perspective a little bit. Okay, using the same thing I just did here. Now we're going to apply a different mode of thinking with the same underlying market conditions. Now, think about what we've done here. Close proximity to liquidity on a daily chart. That means intraday, the market's going to trade down to that low. If you're using intermarket relationships and it's the dollar index that you're doing the analysis on, it's likely to do something like this. That means that the Forex pairs that have the dollar index in the second name, pound dollar, euro dollar, Aussie dollar. So that means the pairs that have the US dollar second in its name, when it's opening here on the dollar and it's going to drop down into that low and below it, okay? When it does that, these types of currencies in Forex are going to go up until the liquidity below that low here is taken. Then the easiest low-hanging fruit objective for you is to sell your euro long, pound dollar long, Aussie dollar long. Now, for currency pairs that have the dollar index in the front of the name, that's USD, JPY, dollar Swissy, okay? And they will do the same thing. They will mirror what the dollar index will do. So there'll be some kind of a low that they're reaching for too. But you want to make sure, here's very important. Please don't miss this point, okay? When you're trading with positive correlated Forex pairs with the dollar index and your analysis is being framed on the dollar index all the time in Forex, always. If you're not trading with the dollar-based idea, you are trading blind, okay? So we're in close proximity of this low for dollar. It's going to likely draw down to that. Dollar yen, dollar Swissy, they're going to drop too. But the low here's the kicker. The low that may be also something that you're aiming for, relatively the same time that this is being formed. So in other words, on Tuesday, July 1st of 2025, there might be a low on the dollar yen or the dollar Swissy, comparably at that low, but it may not take that low. How could that possibly happen? If the dollar's going to take its low, why wouldn't the dollar yen and the dollar Swissy take its low? SMT. So having the analysis anchored to the dollar, that means when this low is taken there, that is when you close your short on dollar yen, dollar Swissy, or any pair that starts with the dollar in the front of the name of the pair. Remember, these up here with the dollar index to the right, there's a second name in the title of the pair, they're going to be moving the opposite direction. Okay, so very, very important. You have to keep in perspective what the dollar's doing, because if this thing's going to move, it's going to affect the currency pairs that you're trading. And SMT, which is a divergence, and visually, that's essentially what we're expecting in dollar. That low, this low piercing that low. That's the old low. This is the low we anticipate forming below the previous one. That's this visually here. But we may see, comparably, we may see a low in the dollar yen, and it's getting real close to it, but it may not go all the way below. It might go right just above it and then pull away. And then you have the dollar Swissy. It might agree and go that slightly lower low. But what do we have? We have a divergence in positively correlated currencies. This is what we anticipate in dollar. This is the reality with yen. It says, no, I'm not going to go lower. And this here does go lower. If this happens, that could be indicative of a shift in internals that's going to support or cause a larger magnitude reversal mindset on the dollar index, because big money, remember I was telling you earlier in the beginning of this live stream, is that they don't have the benefit of going into the marketplace on a very small short-term time frame. They have to move throughout blocks of price action that they have to implement over time. It can't be their full positions placed on right now, because they're trying to hide what it is they're doing. And they also have to use the available liquidity that's available in the marketplace. There isn't always the amount of liquidity at that tick in the next 1 minute candlestick time frame. All the price action that took place in that 1 minute or 5 minute candle isn't enough for all of these banks globally to shove all their orders in on that one candlestick. Okay, so that's not what they're doing. They're not trading on one candlestick entry and that's it, and then we're done. But what they're doing is they're accumulating the sell stops below here, and then they're buying more at that opening price. So the opening price here, when price goes down below that, if you're a working class hero, okay, or in the process of becoming one, you don't need an intraday chart. You can have the same expectation and anticipate that they're going to drop from that opening price down there. If you anticipate that price opening on that candle, you get the opening price, see when we're in close proximity, like as soon as they close here like that, okay, wonderful. Then wait for the new candle for the daily chart to open up, get the opening price. Then you know that it's likely to traverse and go down to that low, and you want to see it trade below it. As soon as it does that, as soon as it gives you this information, you already know that you can have a buy stop. The idea is that once it does this, you're not in front of the charts when it's doing this. You don't need to be. As soon as it comes right back up and hits that opening price again, if your premise is correct, if you are right about the ideas that you think that it's going to go down here and take the liquidity and then start the run on a smart money reversal basis, are you getting long down here at the low on turtle soup? Nope. Because your idea is it's going to go up to, now here's the test for you guys that have been studying through my private mentorship. Where is the draw after smart money reversal? It's a trick question now. So what you do is you want to take your high down to the low that formed intraday, and it comes back to that opening price. As soon as it comes back to opening price and trades one tick above it, you're immediately inside of a new buy program. So this is kind of like a little play on words with order block theory. It's the reverse. Yeah, how about that? This opening price on that candlestick, as soon as it hits that, you can be long. Here we have the high, and this would be the original consolidation, or where the draw would be on a perfect market maker buy model. The market's going to go up here. But in your infancy as a developing smart money concept trader, you don't hold to that idea all the time. You have to have a low hanging fruit objective. What would that be? 3/4 of the move, okay, or optimal trade entry. Because if you studied with me and you went through private mentorship, you know that a market maker buy model and a market maker sell model does not have to go all the way back to the original consolidation or opposing liquidity. That's just the best case scenario. Low hanging fruit objective would be reaching up to 70.5, which is the sweet spot or optimal trade entry between the 68 79% retracement levels. But here, this is low hanging fruit. That means that this is all you would require getting up to from that low. You don't need it to go up to here, but it still can. Now, as soon as it opens and it trades down below here, okay, what you can do is put a good till cancel buy order in the form of a buy stop. As soon as that low gets taken out, you put a good till canceled buy stop in your paper trading account. Okay. When it trades there, then you use that low as your stop, or maybe a little bit below it, because you just want to have no concern about it. Once it fills, your objective is to aim for that 70.5 level. That's your working class hero model. You're trading the same things that we're trading with intraday charts. You're using very specific criteria. You're not willy-nillying and worrying about what's fair value gap to buy. You're not worried about what order block to buy. It's a very static price entry. It's very, very generic, and it works. But you don't need to be a market maker buy model or sell model trader that demands Okay, we're going to have a huge paradigm shift right here. We don't demand that it goes coast to coast from down here where deep sell side is all the way back up to the buy side, which I told you it could potentially reach for, but I told you specifically we're going to aim inside this inefficiency. The easiest draw, low hanging fruit, if you're trading a market maker buy model, is 70.5 of the range. What is the range? What is the dealing range? How you frame your market maker buy model or sell model? Here's the high, and that's the low it's going to trade down to. Why? It's going to go there. So from that low, once it trades there or through it, when it creates that low and comes back up to that candlestick that trades down to the low, that opening price is very, very crucial. Very crucial. It is a PDA rate. I'm not going to reveal its name, but that function frames the whole basis of returning back inside the range, and that range is this. And I don't need it to trade outside of the range high here to be profitable. I mean, what happens if you just traded to this high here for a minor buy side? Why is it minor buy side? Why'd you call it that, Michael? Because it's not even at 70.5 of the full range that's here from here down to there. That's a dealing range. The market has dealt in between here. So if it goes back up inside that range, you're doing the same thing. You're dealing inside that range. That means you need to know what you're looking for. Where is there an easy draw on liquidity? Okay. But if you're doing it and you're using this model, 70.5 is way up here, right at that high, conveniently. Okay. So what would be easy objective, low hanging fruit objective for you if you're trying to grow in that and you don't want to wrestle through all the anxieties that's going to come? Well, what's the first swing high from that low? Go back. Bang, right there. So that would be your draw to initially. Okay. And also, you can blend it with purge and revert, where it runs down, takes out the low, which is a smart money reversal premise. It's going to go up to go down. It's going to go down to go up. That's a premise. Narrative is once it does that, how is it going to go up? Where is it going to go to next? Well, we're going to walk that out now. So, purge and revert. Purge and revert is when we take a low out like that. If you're reaching down below a low for liquidity purposes. Now, this is a very, very powerful concept, but it doesn't require a whole lot of movement. There's not a lot of moving parts either. Okay, so as soon as the low is taken, you go back 3 days. 1, 2, 3. That high right there. That's the liquidity it's going to draw to. That's it. That's your model. You don't even need it to go back to this high. You don't need it to go back to this high, that high, that high. 70.5 level, sweet spot, optimal trading street, 70.5. So that, look at that high, right, sitting right there. It's almost like it knew it was going to create that, right? See, that's what I started seeing. These things, that low didn't even exist yet, but this so happens to be right at the 70.5 level. Purge and revert could be your complete model if you're outside of intraday charts. Using a daily chart like this, are you going to get a lot of trades? No. You won't trade every day, but guess what? You have to be willing to accept the fact that you're demanding a whole lot from the market. Give me setups with only this criteria of time availability. Oh, that's, this is what you get. You're going to wait for, key highs and lows. And I'll amplify that in a minute. But purge and revert is the high after a low's been taken, go back 3 days, whatever that high is, that's the liquidity it's going to run back to. It's high probability short-term, basically algorithmic trading. There's many algorithms that fire on that same premise that this is what I'm looking for, and I'm done. They're not aiming for 70.5. They're not aiming for the full run up in here. That's a best case scenario. So if you're trading turtle soup ideas with technically what it is smart money reversal. Purge and revert is a very short little run to liquidity, opposing liquidity. Okay. And you don't need a whole lot of the run inside of the dealing range to get to profitability for your setups. So the idea is this: when we're looking for prices to move higher, we are entering or should have entered a buy program. As soon as price gets back above this opening price, that's essentially what we're doing. So from that point here, now watch, this is what you want to internalize. From that here all the way up to that high right here. Now, why am I picking this high right there? Because that's the 70.5 measurement from that high down to that low that formed. So that's the low hanging fruit objective for market maker buy model. Before you get to that, you can use purge and revert, which is the high 3 days back from when the low was taken. And there it is right there. So you don't even need this. From this point here to that opening price, that is the core of your buy program. That means every facet, listen, every facet, my market maker buy model and sell model, all of the pertinent details for entering it are going to exist inside that range. What do I mean by that? Watch. That's that range just being projected to the buy side of the curve. What does that mean? So the buy side of a market maker model, okay, market maker model is the down to go up, okay? This is smart money reversal. The low is the smart money reversal that takes out opposing liquidity. And now we enter right on this candlestick's opening price. We enter the actual buy program up to 70.5 of the previous days or previous trading dealing range, which is that high, which is the highest high it was prior to it dropping down to that low. That's all we're doing, okay? That's why I'm picking this high. It was very reactionary, impulsive. It dropped aggressively. There's a lot of momentum away from that high, and it's easy to frame it. That's an easy high, and that's the low we anticipated forming. And as soon as that candlestick trades back above the opening price of this candlestick, then we entered technically, algorithmically, we're now in a buy program. That means the market is now bullish order flow. And these candlesticks march to that. Don't believe me? Watch. Inversion fair value gap. That was called before it formed. Trades above it. That closed right here above the inversion fair value gap. There's a small little imbalance in here, volume imbalance. Yeah, incorporate that. That closed right there, bang. Validates it will be an inversion fair value gap. The point is it validated the inversion fair value gap. So we'll let it run a little bit. Let it have a little bit of rope. Let it run. Just like your pet is going to run until it gets to the end of the leash, and it's going to come right back, bang, right back down to what? Consequent encroachment. That funny, weird name. I wish he would have gave it a different name. Trades right down to that midpoint of that inversion fair value gap. Then it rips and roars to purge and revert. Rallies beautifully. In the process, it creates what? Buy side imbalance, sell side inefficiency, and a bullish fair value gap. Two down closed candles inside of the inversion fair value gap and the displacement higher, that opening price right there. It's consecutive down closed candles. That opening price, draw that out in time. It's using that, but incorporates the entire buy side imbalance, sell side inefficiency. So if you were going to go long and you were looking on the basis of smart money reversal entry, it's always a turtle soup of a market maker buy or sell model. Always, always, always. When we have the market enter into the actual buy program, and again, for definition purposes, the idea is this. Once you are in the part of the market maker buy model, you want to encapsulate where my stuff is going to form. Where is it going to form? Not when. I'll tell you when in a minute. Where is it going to form? It's inside of the previous scaling range, high and low of a market maker buy model. And you have to find the 70.5 level of that range, which is what we already identified. And it happens to be just right at that high right there. So inside of this range, all I'm shading here is the same range from that opening price. Once we ran through that low and it came back to that opening price and went higher, that's validating that that was a stop hunt. If everything is true, now listen, this is the if-then statement or the syntax of the algorithm that you should be thinking like when you're looking at price action. When we're looking at things that derive the outcome that we're hoping for, being profitable, if we're going long, we need to know where we're going to enter and how will the underlying order flow prove to you that it's bullish. Okay, so here we're inside of a range that has the high probability of sending price higher to the 70.5 level. And now we're going to be looking for footholds. We want to climb this rock surface up to this high. From this low right here at that opening price, we believe it's going to start gravitating towards that high because it's 70.5 of this entire range. That high down to the low that formed. So you're a rock climber. You're bullish. The bottom line is you're going to look for all of my IPDA arrays to form. All of them. Whether you like one special one over another, it doesn't matter. The buy side here, perfect. Ran it. Now what's it doing? Those turtle soup buyers on a breakout are getting souped. What do you think this is? From here to there. It's the opposite of what we're outlining from here to there. It's a market maker sell model. Yeah. Everything's fractal. Everything is fractal. That means the thing that you're looking for in price, that's your fractal. The bodies are allowed to stay in the upper half of a inefficiency that I call as a fair value gap. The wicks are allowed to do the damage. That means they can traverse down below the midpoint of that fair value gap. The fair value gap is this candlestick high, this candlestick's low. That's why it's shaded in that blue area right there. Dividing that in half, that's the halfway point. So if we're looking at an inefficiency or a wick, it's always called consequent encroachment. Consequent encroachment is the midpoint of an inefficiency or gap. If it is a candlestick like this one here, or these two, that's a bullish order block. The middle of that is called mean threshold. So it's supporting bullish order flow because the bodies are allowed to go down to the low, below that midpoint of this gap, but it doesn't close below the midpoint. You see that? So every single time it does this, boom, this wick drops down and gets real close to this candlestick's high. Now, when it's bullish, what did I teach you? The best case scenario, okay, in everybody's ideas of inefficiencies is it completely closes in the inefficiency. That means this candlestick's high right here. It would touch that. Does it touch it? No. That's what I want. And this level here is the consequent encouragement right there. We'll darken it up right there. See that? Untouched. Consequent encouragement. It wicks down through it. Now, as soon as it creates that wick down here and it doesn't completely close in and comes right back up here, I already know at that point that order flow is absolutely still bullish because this didn't deliver all the way down to where it could have, and it didn't. And it closed up there. So now I'm expecting what? We got a new wick. We got a new wick. What do you do with that? ICT. What do you do with that? You measure it where I said it's going to be. Order flow is bullish. We're inside of a buy program. It's going higher. Well, how can we trust it? How do we know? If you look right here, very faint, okay, I'm measuring this wick, and I've measured this closing price down to that low, okay? Here's the lower quadrant level of that wick. When order flow is bullish, but there's an nice big order right below this low ICT. What are you going to do about that? I'm going to ignore it. Why? Dollar index has this wick, and we're bullish. The next candle opens right there. Now watch. It's at some point after that opening, it's trading down to the upper quadrant. That's permissible. Absolutely permissible. And then it trades down to consequent encroachment. Remember, I marked that line here? That's permissible. We do not want to see the body left underneath that level right here. But can it trade to there? That's a lower quadrant or the mid quadrant of that wick. This is the fair value gap, consequent encroachment. That's reasonable. It's expected to do that, but we don't want to see the body left underneath that. Same approach and application of the actual wick, which is this open down to that low. That's the midpoint of that wick right here. Can it trade down to that and it be permissible? Yes. We do not want to see the bodies left once the candle closes. It cannot do that. If it does that, guess what that means? You cut half the trade or close it if you're already long. But when I'm long and I use this strategy, where do I place my stop loss? You wait for this. Watch what's happening, folks. Watch. This wick that's diving down, where everybody else would be freaking out thinking, oh no, the dollar index is going to crash. It opened here and now it's trading down. It's getting ready to take out that low. The hell it is. No, it's not. It's just redelivering and filling the numbers. What numbers are you talking about, ICT? Here's your lower quadrant. That's as far as you want it to go. And then now what? What happens next? Candlestick opens up here. We got a wick again. Oh no, what are we gonna do now? It's trading down. Look where it went. Look where it went. Yeah, look where it didn't go. Look where it didn't go. It didn't go to consequent encroachment of that bullish fair value gap. It didn't get down to consequent encroachment of that bullish fair value gap. That's a good thing. That's a real good thing. New wick, new range. Order flows bullish. Main one, there's an hierarchy. You're inside of this PD array on the daily chart. This is a bullish fair value gap. It can traverse down in the lower half, only wicks. But as soon as we place one down here like that, we have now limited the order flow in a way where we can see what's permissible and what's not. The next one opens up and trades down, goes right to the lower quadrant, only to the tick. New wick, grade it. Consequent encroachment of the wick and, watch, consequent encroachment of the bullish fair value gap. It fails to touch the consequent encroachment of the bullish fair value gap and trades to the consequent encroachment of this new wick, which is the range. We have to measure that. So what intel is it giving you as soon as that close right there happens? It's real bullish. Why? Couldn't get down to the low to close it up. Then we get another wick, drops down perfectly to the tick that nobody ever talked about. And then what it creates this close of this candlestick right there. Where in price action do we have another supporting event that supports that we have now staged another rallying point? What do you see here? Right when this candlestick closes, what's in place in price action? This candlestick's low, this candlestick's low, and now this candlestick's higher. So this is a swing low. Anything at this candlestick's open to low is a good buy. It's a discount. And then we open up on a new week up here. Boom. This little band of trading range. So to recant what it is I'm talking about here, we had smart money reversal, which is always a turtle soup premise. It's a false breakout. Then low risk buy is here you go. Ready? Listen, folks. Listen. Low risk buy is always inversion fair value gap if it offers it to you, which is this here. If there is no fair value gap over here, this smart money reversal forms the very first bullish fair value gap that forms. That is your low risk buy. If it's reversed, it's going to be your low risk sell. Always, never deviating from that. First stage accumulation. The next fair value gap. It has to have an order block. It has to have an order block. Order block, fair value gap. First stage accumulation. Low hanging fruit, 70.5, and that buy side, and that inefficiency I told you about. Here comes your unicorn. The biggest run, the strongest run in a market maker buy or sell model. Here it comes. Ready? Look at that. What do you see there? Inefficiency. Split it in half. Beautiful. Once it clips it, does it close inside this inefficiency? No. It closes up here. You as a trader are going to go short Forex pairs like pound dollar, euro dollar, Aussie dollar when it's trading right in here because the dollar is going to go higher. And it's going to reach for that buy side liquidity right there and then up here. Second stage reaccumulation, the unicorn. Up she goes. All right, so we have this low, which is going to be perfect textbook market maker sell model draw on liquidity. So how do you classify low hanging fruit? The easiest level is going to get to in the market maker sell model. That low up to the high, but here's 70.5. That means it's the low up to this high. That's the low hanging fruit. So in other words, up here, the retracement back in here, which is reasonable, would be this level here. We've did that. Now, if we close below it, it indicates that we're likely to dig into this eventually. Doesn't mean it's going to be a straight shot. It just means that I would trust that it's likely to continue doing that. Gets to euro dollar. I taught you how to make models, how to use parts of a market maker buy and sell model as your fractal. What does that mean? If you're a turtle soup trader, you're using smart money reversals as your entry mechanism. That's the premise that you're trading under. That fractal part of a market maker buy model or sell model is the smart money reversal. The low risk entry, okay, that is a inversion fair value gap or first presented fair value gap after the turn or the curve begins. Okay. So it's one or the other. If there's an inversion fair value gap there, you use that one. If it's not there, you're going to take the very first fair value gap, and that's going to be your low risk entry. That's a fractal. That's the cookie cutter of that model or that market maker buy model. It's one little piece of it that you're using to frame the whole idea why you're taking your trade. Or you're waiting for first stage accumulation or distribution. If you see that form and you missed it, or if you really want, a lot of ammunition behind your next setup, wait for it to deliver. Let it pan out. And then the first retracement back down into the inefficiency is going to be what? Second stage reaccumulation in a market maker buy model. That's the unicorn. That's the big bang for your buck. That's the setup that just goes off to the races. It's so fun. It doesn't wait around. It doesn't delay. It's just real quick, and it runs to that liquidity. Each one of those is a cookie cutter. Each one of those is a fractal part of the market maker or sell or buy model. Each one of them is a component. You need to be aware of all of them if you're going to be using the turtle soup idea of entering at the smart money reversals. Why? Because you will have more conviction behind holding the trade because you know every stage of a market maker model. And you won't be scared when it's retracing against you. You know what it's going to likely do. If there's wicks, grade them. If there's inefficiencies, grade them. Consequent encroachment should be respected. The bodies are allowed to only stay in the upper half of the inefficiencies or gaps or wicks, but they can traverse by their wicks down lower and scare you. If you don't have this logic, you'll get nervous and close trade. But if it drops a body below consequent encroachment of any one of these PD arrays and you hold a position that affords you to do so, cut half the position. Simple. If you entered long here and your stop loss is below the low here, as soon as it creates this swing low here and this candle closes, your stop loss can be brought up right below that low. And now you've locked in whatever that profit would be. Same thing here. Once this creates a swing low and it rallies up, then you can move the stop loss from under here up to there, because second stage reaccumulation on a market maker buy model should ever, never be traded back down through once it forms. If it does, you're wrong, and you want to be stopped out. You want to be out of it by then. Second stage reaccumulation in a market maker buy model never gets a stop hunt on it. Never. It never does. If it does, you're on the wrong side of the marketplace and you want to be out. Second stage reaccumulation in market maker buy model never has a stop rate on it. Second stage redistribution of a market maker sell model never has a stop rate on it. Never. It's too one-sided. It's in a hurry. So that way, if you're positioned ahead of it, that means first stage accumulation, low risk entry, or you were fortunate enough to trade turtle soup long, it helps you manage where your stop loss is. And that's many times why you see me put stop losses in places where I know it ain't going to go. Why is he so confident that it's not going to go? Because I'm using this logic. So we have this inefficiency here when it took out that low. Watch, folks. Here we go. Ready? Sell side. It drops down. Wow. That is what? That's a smart money reversal. Original buy side. Okay, wonderful. It drops down and comes right back up. The gap here is a inversion fair value gap. Why? The premise is the market went down to take liquidity. What liquidity? Sell side over here. If this forms, this right here always will behave as an inversion fair value gap. Yep. So we have the drop down in here. First fair value gap there. You can buy that. That's institutional order flow entry drill. That drop right here. Rips another one here. Order block, draw that out. Hits it again. All time distortion. And then it rips higher. Buy side imbalance, sell side inefficiency. Second stage reaccumulation. First stage accumulation. Low risk entry, smart money reversal. original consolidation or the opposing buy side liquidity hits it. Then it drops down, okay? High to low, 70.5. Reasonable. Did it go down to it? Yes. Did it go lower? Yes. Where did it go to? That inversion fair value gap that was framed on the basis of this market maker buy model. Same thing here, market maker buy model. Now we're in smart money reversal, low risk sell, inversion fair value gap exists. That's the one you use. Breaks down, imbalance, first stage distribution, second stage redistribution, 70.5. What level below these relative equal loads would you use? Inversion fair value gap. Boom. And now we're getting a reaction off of that. So anyway, you want to blend what I said about the dollar index with the euro here, and you'll be able to see a lot of the things are just a mirror image. Everything is a mirror image of what was called for, and what was delivered in dollar is going to be the mirror opposite on euro dollar. Here's the British pound or cable, and market dropped lower, had a nice little inefficiency there, hit that. This wick, before this candlestick formed, this was the lowest reaching wick, so you want to grade that, okay? And in here, you can see how the bodies were unable to get to the high end of it. The wick through it, it's a little bit of something to measure of like a time distortion where it can color outside the lines a little bit, but you have to do what? If you're short, you would collapse half your position and look to another future PDA rate to reestablish that same portion of your trade. No inefficiency here, but we do have a wick. You can grade that if you want, but it breaks lower. All this stuff here would be anchored to this inversion fair value gap. Consequent encroachment, can't get to it there, can't get to it there, and the bodies are left even outside of that inversion fair value gap. So that is what? Is that bullish or is it bearish? Really, really bearish. And sell side's below here, and it tanks down into it there. So cable was actually very nice in terms of what it was willing to do and what the difference between that. Why is cable a heavier sell or short? Or why was, let's say it that way. Why was cable a better short? If you look at the euro dollar, see how tight the declines were? It's not given that much opportunity to move lower. It's real tight and stilted. Whereas you go back to cable, it's allowed to rip lower, rip lower, rip lower. All the down close candles are much larger, much more prominent. So if there is no SMT and you can't ferret out which one's the weaker one, just simply look at how much of the ranges are allowed to perform in euro and cable. And the one that has larger, more prominent down close candles, that's indicating that that's the one that's the weaker one. So the next sell side opportunity that you can draw down into, use the first premium array that forms and get short there and just ride it out. All right, so here's the daily chart of the Dow index. Okay, and for the ideas of usefulness, it's used as like a barometer for me. So if the market, let me make it very clean and clear for you. If the market does something like this, say we're in a bullish market condition, and this is the Dow, okay, and we have a low that's been taken out, and say the S&P comparably does this, and the NASDAQ does that. If this is the Dow in the middle, S&P above it, and the NASDAQ is lower, in the time I'm expecting the market to be bullish, okay, the S&P has more stocks in it than the Dow and the NASDAQ. So by sheer brute force of how many companies that are in the average or index that makes the S&P up, if it fails to make that lower low here, while the Dow does make a lower low and the NASDAQ makes a lower low, this is, by theory, Dow theory, is the basis of SMT. And sometimes it's useful and sometimes it's not. But when the underlying premise is there for the market to be bullish and you get a criteria like this, that really many times signals the low. And that would be basically a turtle soup long below that low for Dow, a turtle soup long below that low for NASDAQ. And this is simply just an optimal trade entry for the S&P. The crack in correlation, meaning at a time when they all do not agree, when it's already bullish, when this failed low below that low, in other words, this is a divergence between these respective lows. If the S&P is doing this, then we're really bullish. If the premise is underlyingly bullish too. And what would that look like? Remember when I was showing you with the dollar index on the daily chart and I showed you how to frame the dealing range it's in? And then once that low was taken out, we entered this range that is the beginning and framework of a buy program. When everything for my market maker buy model is going to form, all facets of it, the low risk entry, reaccumulation, second stage reaccumulation, all of those are going to be inside that range. Inside that little range of price action, when the buy program should manifest all the facets of a buy model or sell model if it's bearish. If you see this criteria in price action, it further presses the envelope of how fast and how hard it's going to go up, because it's really indicating on all checkpoints that it's going to go up. Now, I do not, this is really important, I do not share the same affinity for being wildly bullish if this one is the Dow and this is NASDAQ and this is S&P, or vice versa. If the diverging average is the Dow, I don't care. There's many times where you'll see a divergence in the Dow, and you might look at that and say, oh, it's a SMT divergence and it's going to cause all the averages to change. I have lost a lot of money trying to do that initially. And I've learned by lesson of money leaving my hands that the greater importance is placed on the S&P most, then the NASDAQ. I will take a SMT divergence or Dow theory, converge, all the averages being confirmed with one another. In a perfect world, every low should be matched with the Dow, the NASDAQ, and the S&P. But there are times when one of those averages diverge. And the importance I'm trying to place on an emphasis on is if the divergence like this is forming when you're bullish and this is the S&P, that's kind of like a loaded deal. If it's the NASDAQ, I have affinity for that one, but it would be better if it would have been in the S&P. Sometimes both the S&P and the NASDAQ fail to do that, and the Dow will make that lower low. Does that mean the Dow is telling you it's weaker? It's not. So hopefully I've corrected you and recalibrated your expectations as it relates to SMT or looking at the averages in this capacity. All right, so right away, let's assume for a moment that we're in some kind of a deeper retracement, and we might be, folks. The Dow looks real clean right there. You see that? The sell side liquidity resting below here, it's validated and qualified as a potential candidate because the low that's anchored here has a higher low to it. So that's how we look at relative equal highs and relative equal lows. The most recent low with relative equal lows, it needs to be higher than the one you're anchored to. Because they're close proximity and same price. The one slightly higher is a validation that this is likely to be attacked at some time. It doesn't mean it's going to be a straight shot right to it. It just means that this is a likely condition that could draw to over time. So it's an intermediate term perspective or analysis. You see this gap right here? You want to have that on your chart and treat that as inversion. Why? Because we traded down below it. It has passed down through it here and then up here, and now we're down below it. So we have done the work of delivering the absence of buy-side delivery. Now, buy-side delivery is simply the market moving higher from one point to a higher point. Sell-side delivery is simply just the market moving from a high point to a lower point, and it leaves bodies across both directions. What does that mean? If this gap is framed with this candlestick's open, this candlestick's close, in essence, this is the range. See, it's got a little bit of a wick here and it's got a little bit of a wick here, but they don't touch. There's no kiss between these two. There's a small little gap. This is a common gap. I call it a vacuum block, where there's an absence of any real price action there. Zero. Okay. That's imbalance. There's nothing there. Okay. Well, this portion of movement here with this big up close candle, it is an inefficiency. It's inefficient in sell side delivery. It's a buy side imbalance. So it's one-sided up move, but it's deficient in having sell side delivery. So it needs to have what? Sell side delivery, which is a pass back down over top of this range. This portion right in here is an actual absence of both buying and selling. Nobody did any trading between this candlestick's wick high and this candlestick's low. There's a real vacuum of any trading there. This is a liquidity void. It's void of any liquidity because nothing took place there. So that's a real improvement in terms of terminology. But because there's no bodies left in these two price points here that I'm framing with the candlesticks closed and candlesticks open there, that right there is a volume imbalance, but it's encapsulating a vacuum block or common gap. When we saw price drop down and laid the body down over top of this candlestick's close from this candlestick's open, that's these two trend line segments I've highlighted here, this opening price and that closing price, that frames the volume imbalance. So when the candlestick comes down like this, stops, the next candle opens and stops right there, we have done what? We have delivered sell side delivery. It offered price on the downside. That is not efficient anymore, or yet rather, because it has not offered buy side delivery at all yet, because it went this far, stopped, and closed there, and then opened up here. Well, what about the difference between this candlestick's wick high and this candlestick's low? There's nothing in there, and there's no bodies in between the close and the open of that price. It's a volume imbalance. There's no volume offered at all on a candlestick basis. Okay? If you're not using time-based candlesticks, you're not looking at price the way the algorithm delivers it. But this is sell-side delivery. Now, what does it become? All that has done is turn this volume imbalance into now a sell-side imbalance, buy-side inefficiency, or SIBI. What? Yes, it's changing its character. What's character? The volume imbalance now becomes a sell-side imbalance, buy-side inefficiency because it's only sell-side offered. What is it lacking? Buy-side delivery. When does that come? Here. Candlestick comes inside the range that's shaded here. It closes. The next one opens, trades down a little bit, and comes up here and closes outside of it. So now we have sell-side delivery. That's sell-side delivery. It's the same as a SIBI. Same thing. At this point, that's all it is. So what is it lacking? Buy-side delivery. So that means it's going to roll that paint roller up the wall here, where it takes it down like this. Well, then you're going to take the same paint roller and roll right back up to make sure the paint is done what? Efficiently delivered inside of that volume imbalance right there. And you see it happening right there. So now in this area, what was inefficient on both sides of the equation, buy side and sell side, it became only efficient on buy side because sell side was offered here. So the paint roller was drawn down to put paint from this candlestick's open and that candlestick's close. Then it rolls right back up. So now this whole area has become efficient, but it's an old inefficiency. So if we trade down below it like this, it needs to be viewed as a potential what? Inversion fair value gap, because it can reclaim each one of these positions of inefficiency and the original area over here of inefficiency. Long story short, we cut through candles. We don't look at liquidity voids. We look at how price has been offered and how it was delivered. So if it were to trade up in here, as long as it stays below the midpoint, it could be bearish and send it lower.